Morning everyone, this is Rajendran here joining from Market Calls and welcome everyone to training session on Introduction to Market Profile. So this is a preview session for our upcoming training program on TradeZilla 2.0. It's an mentorship program for market profile and order flow. So before getting into the session, just give me a quick confirmation on the audio and video quality. Is the audio and video quality good so that we can move with the session? And as usual, the session is getting recorded and the recorded session will be posted to the YouTube. Okay, thank you everyone. I guess then we are good to go with the session, right? So about me, my name is Rajendran. I'm the founder of Market Calls and co-founder of Traders Cafe. I've been writing in Market Calls since 2007 onwards, closely written on various technical analysis topics, explored various technical analysis softwares, mostly on automation, market profile, and order flow. So my core expertise is on market profile, order flow analytics, building trading systems and building indicators. We had worked closely with a couple of institutions and retail clients, and mostly on automated trading system development. I'm a trainer for more than 6+ years now. I've been trained more than 700+ professional traders on market profile, order flow, AMI broker trading systems, and automation. The software which I'm going to use in today's section is NinjaTrader 8 platform. On top of that, we are going to use an third-party NinjaTrader partners indicator, Well TPO, for order flow and market profile studies. I've been using NinjaTrader 8 for quite some time. Previously, I used to use NinjaTrader 7 for market profile and order flow. Now, I completely shifted my studies, all my studies related to market profile and order flow to NinjaTrader 8 platform. Right? Otherwise, I'm a core AMI broker user. I've been using AMI broker since 2008 onwards. Right? So 8 or 9 onwards, I've been a core AMI broker user and closely coded 60+ systems, and most of my systems are available open source in my portal, marketcalls.in. And here is my Twitter ID, marketcalls_. And my email ID is rajendran@marketcalls.in. If you have any queries related to market profile or order flow, anytime you can shoot a question to my email ID. When it comes to trading, I'm more of a Nifty and Bank Nifty mean reversion trader. And also, we do trend following as well. We mostly take an view-based trading by reading the market profile and order flow charts. Otherwise, when it comes to systematic, I'm more of a mathematical trend follower. And especially when it comes to futures, right? So futures and options, I trade mostly Nifty and Bank Nifty and a couple of stocks as well. So in today's session, we are going to discuss about what is market profile and why one should use market profile as a full-time career, right? So market profile is a tool, right? It's not an indicator. It's a tool. We call that as it's kind of a visualization tool to understand what kind of market participants. When I say market participants, I'm saying that what kind of traders are coming into the market, right? So it ideally talks about the traders' behavior, who is coming into the markets, and then it explains how the traders are behaving in the markets. So market profile records all those information, and then those informations are recorded in the form of profile distribution. We call that as a profile distribution. And from those meaningful profile distribution, we have to interpret what kind of traders' behavior or emotions are going on. Of course, we have an objective framework to understand what kind of behavior is going on, right? So it doesn't give buy or sell signal. It will not tell you where to enter, where to exit, but all it says about is about what kind of players are coming into it. Am I dealing with an intraday trader? Am I dealing with a short-term player? Am I dealing with short-term player with smart money? Or am I dealing with institution with long-term money? Or am I dealing with some sort of an intraday trader? Or both intraday traders and short-term players are present? How do I know that what is really happening inside the market? It is like understanding what your competition is doing. And why it is so necessary? It is very much necessary because without knowing what your competition is doing, It's tough to do a business in this markets. Let it be any business. Do you think without knowing your competitor, what your competitor is doing, can you run a business, any new business? You are trying to venture into a business without doing a competitor analysis. Do you think it is you can really succeed in those in your business career? Of course not, right? The same way, without knowing what our competitor are doing, how do you can take a judgmental decision by looking into the price-based indicators? Many traders are obsessed with price-based indicators. Of course, most of the small traders are the traders who are experienced with 3 or 4 years. They mostly rely on some sort of indicators. The indicators could be mostly on RSI, Bollinger Bands, MACD. Right? I'm not talking about that those indicators will not work. Those classical technical analysis indicators, right? They are mostly derivative of price-based indicator. It just mostly reveals what the price is doing. It just informs what the price is doing. And of course, price is the leading indicator, by the way. But most of the RSI or stochastics or MACD or let it be any other classical technical analysis studies, the moving averages, they are nothing but mere mathematical formulas which is derived from the price. Yeah, some indicators could be a derivative of price plus price or volume, or very rarely it could be some open interest based combinations. But most of the indicators, if you go back and check all your indicators, they're nothing but a formula which is derived based upon what the price is doing. And people used to take a judgmental decision by looking into it. The problem there is that many people are watching the price, are price-based indicators. Most of the traders, right? Most of the traders, they just looking into the price in some other form, and that is the reason that makes the people to take emotional decisions. They sometimes people feel that impulsiveness to take some unwanted judgmental decision. All in a sudden, market opens big gap down. That panics many people. That brings fear into the people. That brings fear because some other way the people are watching the price, even though it doesn't matter what your indicators are saying. But people watches those information, and rather than taking an objective decision, people get into emotional trading. People get into subjective decision again and again, repeatedly. All in a sudden, market spikes up. People go crazy, and then again they take subjective decision. They know that they are taking subjective decisions, right? So this is a behavior. There are a lot of emotional behavior which is going on in the markets, which one will be able to understand from the market profile. If you know that kind of emotions are running through it, one can take advantage either from an intraday perspective or from a short-term perspective, right? If you that is what I'm talking about. What if you know what your competition is doing, one can take advantage of those traders. Those traders can be weaker hand traders, or those traders can be stronger hand traders. If you are able to spot a weaker hand trading activity in the markets today, then you can exactly go and do a counter trading against them. You can do an mean reversion trading against them. If you know stronger hands are joining the markets, you don't have any other options. Probably you have to attach with them, and then you have to go with the flow of the stronger hands. Right. So the market profile itself, it helps intraday traders and short-term traders to effectively understand what the market as a crowd is doing. Not only one trader is going to move the markets, right? It's a layer of crowd is going to move the markets. So that information, you'll be able to record it, and that information keeps on changing. So it is a continuous activity which you have to record during market hours. And thereby, you'll be able to come to a conclusion that what is happening in the market. The very core understanding is what is happening inside the markets. Only if you know what is happening inside the markets, then only you'll be able to derive where to enter, where to keep a stop loss, how long to wait. The how long to wait is the most underrated scenario. The problem with most of the traders is that if you go back and check most of the trades, and I'm not pointing out anyone, but as a trader as a whole, most of the traders are small traders, they trade 1 lots, 2 lots, 3 lots, 4 lots, 5 lots. But if you go back and check your trading activity, when you are placing your trades, right, that you can find a certain behavior there. Most of your trades could be probably entered between 9:15 to within the first half an hour. The market opens, somewhere you'll find an opportunity to take a trade. There are many places. If you go back and check, you could find that most of your trades would have been placed before 11 o'clock or before 12 o'clock. But in the markets, most of your best opportunity, most of the time, it comes after 11 o'clock or 12 o'clock or 1 o'clock or 2 o'clock. At times, it doesn't come at all. But most of the traders having the habit of getting in, getting out, getting in, getting out, getting in, getting out. They want to do some 5 to 6 trades to make some money out of the markets. But they don't want to wait for the best moment, best opportunity. The best moment and best opportunity comes when more and more weaker hand traders are piling in, and market gives a tremendous opportunity. As I said, most of your best opportunity comes around 1 o'clock or 2 o'clock. The question really you have to ask is, are you willing to wait to take that one quality trade or 1 or 2 quality trades in a day, rather than getting in, getting out, getting in, getting out, doing, expecting some, so they don't want to wait most of the time. Rather than waiting for most of the time, the objective is to make some 0.25%. The objective is to make some 2,000 points, 2,000 rupees per day. The objective is to make only 5,000 rupees per day. So that is the objective most of the small trader they have. But rather than that, there is no learning there. There is no learning. There is no understanding about the markets. If you truly want to understand what is happening inside the market, who is responsible for this move? Hey, there is a 100-point Nifty activity is there. These activity is not by smart money, but maybe it is done only by the emotional traders. How do I know that? How do I know that who is driving this market? Who is the driving force behind this market? Is this market is driven by long-term money, or the market which moved up last Friday or last Thursday, is it done by some small traders or some short-term players? How do I know that? That is what you'll be able to learn from the market profile. Right? It talks only about traders and traders' behavior. And yes, it is an intensive concept, and it requires it requires an complete set of instructions. So on top of this, you need to understand what is the core principles. On top of this, you need to understand what kind of players are taking control every other day. It requires a screen time practice. Let's look into this example. Probably, can anyone say what is happening on this picture? I request people to switch off their webcams because it disturbs the flow of the other traders' learning. You can post on the screen in the meantime what is happening on this picture, what you're seeing in the screen. Flow traders, crowd movements, traders shouting at the stock exchange, seeing a crowd, okay. Emotional trading. No, it's not an emotional trading. It is not an emotional trading. Yeah, traders are participating in the auction. I guess many people are already got introduced to the concept of market profile. Right. So the picture what you're seeing is a typical flow traders. At least now we are in electronic platform, right? So right from in Indian markets 2000 plus onwards, we are in an electronic platforms. But previously, in the US markets, they started a concept called the outcry mechanism, right? So what the players are using is that they are using hand signals. They're showing their hands to buy or sell derivatives. If they are showing their palm towards their face up towards the face, that means they are buying. If they are facing their palms outside their face, that means they are shorting the markets, right? So they used to do a buy and sell on those olden days, that is before 1995 or 1990s. They use hand signals to buy or sell the future derivatives. Those days, there is a lot of sound-based edges there. That means on the floor, physically, all the small traders and big traders, they can watch each other. They know what is happening on. A small trader can come to know that what Goldman Sachs is doing or what a big buyer is doing. And a big buyer also come to know that what the small crowd is doing. Those days, if you are able to hear a lot of sound, let's say previous day high has been taken out. Yesterday's high has been taken out. The price has been taken out by the buyers. By that time, if you're seeing a lot of noise, I mean, if you're hearing a lot of noise getting generated on the floor, that means more and more short-term crowd is participating in that auction, and they are mostly interested in those auctions. So a big trader can watch from the noise itself. They'll be able to understand that they're competing with the big traders. They understand that now in this market, the small traders are present in the markets. But as the price keeps on going up and up and up and up, what happens is that slowly the noise, the intensity of the noise getting decreased and decreased and decreased. Price keeps on going up, but the noise also slowly reduces. The noise is the factor. Those days it given a true edge there. More the noise, more the trading activity, more the volume. But lesser the noise, as the intensity is getting decreased and decreased and decreases. That means more and more short-term players are not participating in the auction. Very less and less people are participating in the trading activity. That means most of the small traders would have been overloaded. Almost then they would have bought to their full capacity. Kind of an overbought situation. So those are the zones where you'll be seeing the floor noise intensity completely drags down to a quiet place. So those are the zones where very less trading activity happens. That means probably the short-term players or the intraday players, they went long to too long. We call that as a long to too long. That is kind of an overbought level. Right? So those days, the big traders use that as an edge to come and trade against those short-term players or intraday players. But these days, it is more of a visual edge rather than a sound-based edge. Once the market becomes completely electronic, those sound-based edge completely gone. And almost there is literally there is no floor trading these days. Very less activity was happening from the floor, and then complete because everyone moved to algos, everyone moved to computer-based trading, everyone moved to electronic markets, and thereby a big trader will not be able to know what the small trader is doing, and the small trader is not able to do what the big traders are doing. But these days, it is more of a sound-based edge to understand the trader's behavior. So how we can understand the trader's behavior by looking into the market profile. That's what we're going to study in the next 1 hour. So why to use market profile? For a variety of reasons, one can use market profile, which many indicators fail to teach. One of the key thing what you can record from the market profile is one can able to understand what kind of trader emotions are running in the markets. And that gives a substantial edge for the traders. If you know that today market was up by 100 points in Nifty, but then if you're seeing more and more emotions, if you're able to read more and more emotions from the profile, that gives a substantial indication that this current uptrend probably it may not prevail. Or if the downtrend is coming up with too many emotions, which you are able to read from the profile, and that provides an indication that they are most likely going to revert back, right? So probably I'll give you a couple of examples, right? So once we're done with this slide, I'll give you a couple of examples. Then the other thing what we will be able to learn is the market confidence. So market confidence is an routine day-to-day activity. We'll be measuring the market confidence every 1 hour to understand how the market as a confidence are behaving, whether the day is driven by the stronger buyers or weaker hand buyers, or stronger sellers or weaker hand sellers. So that we'll be monitoring during real time. It is more of a real time activity, and it is a day-to-day basis activity. Every day when the market opens, we'll be start recording the market confidence. We'll try to understand what kind of players we are dealing with. For example, price opens with a big gap up, or price opens all in a sudden, price takes out previous day high or previous week high and started trading higher. So those are the indications of a high confidence market. So the core objective is to understand whether I'm dealing with a high confidence market or a low confidence markets. If it is a high confidence markets, mostly we'll be looking for a trend following opportunities. If it is a low confidence market, mostly we'll be looking for a mean reversion opportunities. So by looking into the market confidence, one will be able to switch dynamically between should I have follow a swing trading, or probably I have to do a kind of a breakout trading. If I am dealing with the low confidence markets, then I'll be trading against most of the traders. Right? So that means low confidence markets are kind of an equivalent to weaker hand players, weaker hand buyers, or weaker hand sellers. High confidence markets are like stronger hand players, or a strong, mostly you don't have any other option rather than going in line with them. There are a variety of places you can understand high confidence or low confidence places. We have a complete framework which classifies which is a high confidence market, which is a low confidence markets. Then there is one more indication called no confidence. There is no confidence in the markets. So those are the days we'll be able to say that neither buyers are in control, neither sellers are in control. Probably those are the zones where one need to wait patiently, wait for the confidence to change. The confidence is a dynamic indication. The market could change from no confidence day. First half an hour could be no confidence, there won't be no greater activity. You would have seen that many times when RBI announcement is supposed to come around 2 o'clock. Market might be mostly in a range bound mode. Nobody will be in control. You won't find any activity on either of the direction, neither on the upper side, neither on the downside, but market will be moving in a lackluster way. Right, so those are the zones we know that there is no opportunity in the market. Probably rather than betting before the event, it's wait for the event to occur, and then one can let the event comes, let the market reacts to the event. Always, most of your best opportunity comes once the market reacts to the event. But many speculators, many small traders, if you understand the behavior, they have a habit of betting before the event. Right, so that when you learn to know how to read the market confidence, the most of the mistakes which is done by the other traders, which can be eliminated substantially. The combinations of trading emotions and market confidence, it gives more edge about the markets. As a trader, you'll be able to understand, or you'll be able to learn to wait for your best of the best opportunity, the best moment we call it, or the best trade locations. And that is a practice. But just by looking into the charts for 1 or 2 days or 3 days, you will not be able to say where to enter, where to exit. It is not a formula here. What you're learning, what you're going to learn from market profile is not a formula, but it is a framework. You have to cultivate according to your risk. Different people take different risks. Some people want to play in the markets only for 10 points. Some people want to play for 20 points. Some people want to play for 100 points. Some people even want to play for 1,000 points in the markets or for one single trader. So accordingly, their risk-taking nature also varies. But as a trader, if you understand what is happening inside the markets, according to your requirement, according to your understanding, or according to your trading risk-taking nature, you can blend market profile according to your requirement. Probably there are certain opportunities which happens only during 1 o'clock or 2 o'clock. You want to wait for that opportunity and you want to make some quick bucks, probably some 20 points or 30 points. It gives you a habit of waiting for the right information to occur, wait for the right exponential setup to occur, thereby taking your trades. Yeah, market profile also talks about weaker hand players or stronger hand players. Most of the time we look for such kind of information. And we track something called trading inventory. As I said in the previous example, the traders went long to too long. Similarly, the short-term players often go to long to too long. Our intraday players at times go long to too long. At times even long-term players go long to too long or short to too short. So those are the places which is as a warning sign, kind of a warning sign in the markets that market could be taking a reversal with a very fair chance. with a very, very fair chance you'll be able to, some sort of prediction is also involved over here, right? So when you know what is happening in the markets, there are places you can spot a pinpoint price reversals. If you know how to track the trading inventory, and that is an art, right? That is an art, and your understanding about trading inventory changes over a period of time. Over a period of time, after 6 years from here, or 1 year from the down the line, your understanding about the markets gets deeper and deeper, and you'll be able to figure out why the market crashed today. Probably, if you ask any of the traders, or probably most of the traders, if you ask them why the market crashed today, probably they'll be giving a weird explanation. They'll be spotting out that there is a news that FIs are selling, or probably they'll be asking you, if you ask the people why the market went up in the last 1 month, they'll be giving that FIs bought, or they'll be spotting out that some news factor, elections came. But how are you able to spot in during real time when the markets are running, who is taking control of the markets, rather than hearing from the news, rather than hearing from what they're looking after the market hours, after looking into the FI data? How do you know that what kind of players are bought the markets? I'm not talking about during the live markets. Market profile will not tell you FI bought. It will not tell you. But as a trader, what kind of players are coming into the markets? Small traders, or big traders, or institutions? Every kind of trader, they have a trader's behavior. Who is dominating? The small traders, like intraday, only intraday traders are dominating or not? Or small traders are dominating, or big traders are dominating? What kind of crowd I am addressing today, so that I can prepare myself, I can change my strategy according to what kind of players I am dealing for the day. Whether the current swing high, is it secured or not? When I say swing high is secured or not, I'm talking about possible top or bottom formation, whether the bottom formation in the market has been done or not. To what probability? What is the probability that this could be a top, potential market top, or a potential market bottom? Right. So this is a complete, I would say that it's a kind of a radical thinking which you can apply during real-time markets, thereby taking advantage of intraday and swing trading or positional trading or mean reversion trading, whichever the way. There are certain days you'll be doing, you'll be able to understand that this market is a sideways market. So you'll be able, rather than avoiding whipsaws, you'll be able to learn to understand how to trade inside those whipsaws. There are days in market trends, and they'll be able to you'll be able to, you're probably the market profile players who are able to read those information. We call that as a market generated information. They are the very first one to understand that there is something is changing in the markets. Previously there was a sideways market. Now probably there is some change in the markets. But how do I know that there is a change is coming in? And if you know that that change is coming in, probably you are the first one to react to those change. Something is changing in the markets. Probably now, last 10 days, I was dealing only with small traders. I was dealing only with short-term players. But now some sort of long-term money is coming in. Now long-term money is coming in, so that I have to revise my strategy. I cannot play the same old strategy. And again, if you look back, most of your studies, there will be some formula-based, some 5 to 6 indicators, some 5 to 6 formulas. Mostly it does only trend following. It repeatedly does the same thing. But markets does something different every day. I guess by now, if you are already in the markets for 1 or 2 years and watching the markets regularly on continuous basis, you know that markets are not same every day. Yeah, market repeats certain behavior most of the times. But if you look very closely, today's market will be completely different from tomorrow's markets. Tomorrow's market will be completely different from Monday's markets or Tuesday's market. Every other day, we are going to deal. Why it is so? It is so because every day different participants come into the markets, different class of buyers and sellers come into the markets. When I say different class, I'm meaning different time frame based traders. Some people trade only intraday, some people trade only positional. Some days we'll be looking. Some days we'll be seeing more institutional flow. So every day different participant comes into the market. That is the reason why the markets are different every day. So you cannot use the same rule to make money on day-to-day basis consistently. Yeah, that is, if you're still doing that, probably you're lucky and you're doing it on 1 or 2 months in a stretch. Then you're lucky that in that particular phase you are doing good. But the same indicator may not behave the same way in every market situations. So, okay, coming back to the context, right? So the charts, what we are looking is called on the right, left-hand side, what you're seeing is a normal profile. On the right-hand side, what you're seeing is a split profile. Most of the market profile trading tool have the normal profile and the split profile combinations. The tool what I'm showing you is the Bell TPO indicator. You can go and download the trial from belltpo.com. The market profile as a tool, it gives weightage to three aspects. From the three aspects, it not only looks into the price, it also focuses on time and volume. How time is related over here? I'm not seeing any time over here. It's what I'm seeing as a trader. If you're very new to market profile, you would have seen that a lot of ABCD are there in the markets. But where is the time? Every day, only one profile gets generated, right? So every day, only one profile gets generated. But how do I measure time over here? Basically, the letters, each and every letter is called as TPO. TPO means time, price, and opportunities. Time, price, opportunities. So the TPO is nothing but a combination of price, time, and volume. That's what the TPO means. It involves a time element, it involves a price element, it involves a volume element also. So this is 1 day of intraday trading activity, and each and every letter here represents that particular 30 minutes of price action. Every half an hour once, letter means the market starts at 9:15 to 9:45, first half an hour, letter A gets generated. Wherever the price was moving, the price keeps moving up and down all the way. You will be finding that letter A gets printed. Probably I'll show you a simulation of how the day's activity looks like. And letter B, it keeps on moving up and down. The next half an hour, 9:45 to 10:15, the letter B keeps on moving up and down. So that is why if you see the split profile, it looks like as good as your 30-minute charts. So market profile also called as a different way of looking into a 30-minute time frame. There are many things. If you look into the 30-minute charts, you could figure it out if you're watching in the form of a profile distribution. Right, so the letters are getting generated every half an hour once. So there are almost 13 letters every day when it comes to NSE futures, because market moves from 9:15 to 3:30. If it is for MCX or currencies, the number of letters might vary, depends upon the market timings or the market duration. So there are 13 letters every day. And if I compress everything towards the left, what you will be seeing here is that you'll be seeing the profile distribution. You can see that more distribution happens. As I said, each and every letter is called as what? Time, price, opportunities. But now if you focus on the center, you say the center, more letters are there. More the letters means more time is spent. For example, look into this example over here. So how many letters you are able to spot out? Can anybody say at the center? Let me, this is where more activity happened. How many letters are there? Can anybody able to count and reply back? So total 8 letters, right? So what does that 8 letters mean? 8 letters means 8 times, probably the 10,490 has been touched on that particular day. 8 times. It's not only one time. 8 times. 8 times continuously the price, that particular price was coming and testing again and again and again and again. There are days you could find 12 times, 13 times a particular price would have been touched. Why it is happening so? Did you ever notice that in your bar chart why the price is coming and revisiting a certain price point again and again? Probably you might missed if you're looking into the bar chart information. But here, if you look into the edges, the top, call that as a tails. See the tops? Very less information is happening. Hardly only one TPO is there at the top. That means price is spending less time over here. Price is spending less time at the top and day's bottom. At the day's top and bottom. And more activity. When I say more activity, more TPOs, more time price is happening at the center. More activity happens at the center. Oh, this is that particular day's behavior. Yeah. But many days, if you look closely, as the price keeps going up, when the price keeps on going up, the trading activity declines. You could see that the volume activity also declines. Similar way, this we call as a price distribution. Whereas the near to that you are seeing a histogram. That is called as a volume distribution. So the price distribution is also called as market profile or price profile distribution. And the volume distribution are also called as volume at price, or volume at each and every price level. So what the market profile reveals to you is that how the price behavior is spent at each and every price interval. How many times price is spending at each and every price point. Probably at 10,900, how many TPOs got spent? Probably at 10,515, how many TPOs got spent? Probably at 10,520, how many TPOs, how many times the price got spent? That is what you'll be able to learn from the market profile as a basic version. And then you could see the letter O over here. The letter O represents the days open. And the letter hash, it represents the last traded price. Probably it will be ticking up and down all the time. Right? So the letter hash, probably if you're looking on end of the day, that is the close price for the day. So here is the close price. Probably different software uses different combinations. Some people might be using some arrow marks or something. Some people might be using hash symbols to represent where the market is trading currently. We don't look into the candlestick charts. We don't look into the where the price is opening. So the market profile doesn't tells you what is the high low for the candle. If you want, you can watch the candlestick always, right? But why I am watching the market profile chart is that only to understand the trader's behavior, thereby taking the intraday trading advantage, right? And then that is a skill. If it is a skill, it can be learned, right? If it is a skill, it can be learned. It is not a formula. It is not a formula. It is more of a framework. And that using that framework, one can apply those information to any kind of markets, to any kind of asset classes, thereby first understand what is happening inside the markets. Then you'll be able to tell what could happen next without knowing what is happening inside the markets. By looking into the price-based indicators or looking into the Bollinger Band or looking into the stochastics, we are just again and again looking into the price that probably it could bend. Probably the price could take a breakout. Just by looking into the value or the strength of the RSI or the strength of the stochastics, trying to take advantage of those informations are as good as looking into the price. As I said, price is more of an advertising mechanism. So what does price advertising mechanism means? It is like the price is the one which attracts the buyers and sellers into the markets. When the price moves 10 points higher, many people believe that, okay, this might move the markets further. Probably the intraday traders might think that maybe another 10 points it could move. The intraday traders come to a conclusion that because most of the traders have the habit of watching the price or price-based indicators alone. All of a sudden you're seeing a price, all of a sudden spikes up. That turns the eyeballs of most of the buyers and sellers. All of a sudden, people might think, oh my God, price moved up, so maybe I should book the profits. Price is a motivating behavior. It motivates people to buy or sell. It is a motivating behavior. We call that as an advertising behavior. Right? So it brings greed, it brings fear into the people just because they are watching the price. You would have been seeing this. Many people, they have a habit of watching the terminals, the red and green flashing all the time, or red and blue. in most of the terminals. All in a sudden, Reliance jumps up 5%. Our BHL was moving down by 6%. It attracts the traders' eyeballs. Probably they don't have a plan to trade at all, but all in a sudden they want to put their they quickly open their charts. They look into the charts. RSI was probably oversold or hourly turned to sell. They see a divergence, and all in a sudden they jump into the trade. So what motivates here? The price motivates here to take decisions. Price is the one people watch. People have the habit of watching the price. Many people have the habit of watching the price. They mostly watch the same level again and again. They will be watching where is today's high, where is today's low, where is previous day high, where is previous day low. When yesterday's high has been taken out, just like in the flow trading activity happened, the same emotions prevails among the current day's traders also. And yesterday high taken out, all of a sudden, many times you have seen that, all of a sudden price takes out yesterday's high. And then you go back and check into the indicators, and then people punch the orders. That is what most of the trader does. And many people have the habit of watching trend lines, EMA, Bollinger Bands, 200-day moving averages, right? So probably if anybody could say what is there on your screen, that helps everyone to understand what most of the traders use. What is on your screen? Probably some sort of an price-based studies, Ichimoku, Renko. If you look back again and again, there is a certain set of behavior you'll be able to understand. You can post on what kind of tools you're using currently. You could post here in the group chat. Point and figure. Yes. What else you people are using it on your screen? VWAP, range bars, open interest. Pivot points. Pivot points, again, some sort of reference levels. Swing highs, swing lows. Yeah, mostly used ADX. Some people use patterns, MACD and RSI, candlestick charts, super trends, stochastics, price action, RSI, GAN. Yeah, a lot of wide varieties of studies today, right? So pivot based, Surrey math. Oh my God. Okay, people are going really crazy. Like they are finding weird names all the time. And so if you understand it is a cycle, right? So people initially they start with RSI, EMA, MACD. They figure out there are some sort of difficulties, and then they move to the next level. Then they find out that something interesting, Renko or point and figure, and then again they move to something interesting, Elliott wave, GAN. They keep on circling around only to understand how to get the edge, how to understand the markets, why the market is moving, right? The true buyers and sellers behavior. The true buyers and sellers behavior, if you want to understand, many indicators will tell only from the price-based perspective why the price is moving, or the open interest-based perspective why the price is moving. But anytime do we really looked into this close what the buyers and sellers are doing? Do we anytime try to anticipate what kind of trading activity is happening today, right? So yeah, so that is what market profile focus on. But now in today's section, we are going to look some of the basics, how the market profile distribution forms. That helps traders to understand. So this is a sample chart by 9:15 to 9:45. It records the price activity of letter A. So letter A is first half an hour price activity. Price keeps on moving up and down, up and down. As I said, it doesn't record where the high. It records only how high the price went, how low the price went. It doesn't record where the price opens or where the price closes. It doesn't record, and it's needless to look into those information. And many people are again and again obsessed with how do I know where the letter A closed? Yeah, probably some tools have access to those. Otherwise, it's as good as you can open your candlestick charts and watch it out. Now, once the letter B comes, the letter B starts by 9:45 to 10:15. Could see some price activity happening over here. And letter C, you could see some sort of an distribution. You'll be able to see that. So you could see some distribution where the price is widening. You can see that some prices started widening over here in this band. Letter A, B, C. Maybe that could be the equilibrium point for the day. Maybe as I said, every day the price try to do more activity at the center most of the days. This is some 60 to 70% of the time. Most of the price-based activity happens at the center. Right? That means that is an edge. So how it is an edge? It is an edge because when the price is moving faster away from that, there is every possibility that again letter D or letter E or letter F, some other letters could come back and does some more activity again over here. So you could find many times like this, like market will keep on moving in up and down activity like this. All in mid of the day price crashes. Mid of the day price crashes and again it reverts back. You might wondering why it is reverting back. It is reverting back because that is the center point is where the most trading activity is happening. So price has the habit of rotating back towards the center. We call that as a rotation. Price is rotating back towards the center. And there are many times you'll be able to predict that price could now most likely have the highest odds of rotating towards the center. Right. So here in this example, you can see that the price is widening. The letter initially it was ABC, and then it becomes ABCD, and then it becomes ABCDE. It is building an equilibrium point. Price is attaining the equilibrium point where at the center more and more people are interested to trade. That is the habit that makes you to wait, not to take any wrong judgment unless you see an opportunity. Maybe this day is balancing day. When I say balancing day, more and more activity happens at the center. Now you see that letter F also joins, letter G also joins, letter H also joins. Because the activity was more and more balancing at the center, means nobody is in control in the market. Just market keeps on moving up and down, up and down. Probably if you want to take a trade, you have to wait for somebody to react, some buyers or some sellers to react. No matter what the indicators are saying, as long as the markets are moving in a sideways markets, the indicator will be doing something what the price is doing. But if you understand the behavior here, that price is widening. If you look at 945, look at the snapshot of every half an hour once. You could see that the price is widening. Maybe still it's not the right place to take an activity. Right? So what you could do in those case kind of days are there. When the price spikes up and the volume activity was declining, then you know that the day's volume, the day's low volume and the day's high volume are kind of zones where the less and less volume activity happens at the center. Less and less activity happens at the day's edges than at the center. So those are the zones which will make you to understand. If you see that zone, we will be measuring the confidence. If the confidence is the confidence towards the price direction is very less, then we expect a mean reversion. By that time, when the price was reaching a certain level, it was breaking yesterday's high or 2-day high. If you watch out the confidence, if the confidence is good, then we expect a continuation. Right? So it's a combination of activity. It's not just we are looking into the price distribution alone. Many things, a combination of factors, we look into it to take a decision. That is why it requires a practice. It requires a continuous practice. Thereby one can master it. So coming back to the session, so in this case, we just looked into how the market profile activity happens. What I want to show you is that I'm going to randomly take some days and then I'm going to show you how the distribution happens in the markets. So here is the price chart of Reliance. Here I'm using you see the letters get compressed and then expands. The tool what I'm using is Bell Market Profile Ultimate. It's one of the finest tool in the world. It's a world-class product to record market activity. Of course, Bell TPO, they provide a market profile and order flow tools and a wide variety of tools, something like VSA, and even they are coming up with price action based indicators as well. So let's take 29th activity. 29th activity could find something interesting. What I'm going to do here is that I'm going to disconnect from my feed. I'm going to run it like how the market runs. Like I'm going to do a bar replay, kind of a bar simulation. So before getting into that, you need to know what is the size of the letter A. Each and every letter A, how we can represent it. So there is a software control over here. Right click and I'll go to indicators. Of course, the tool which I'm using is NinjaTrader 8 platform. So the TPO size, I can vary it. So the TPO size, if I say 10, The 10 will be multiplied by the tick size. The tick size is the minimum possible price action movement, which is 0.05, 5 paise. And 5 paise will be multiplied by 10, that means 50 paise. So every 50 paise, I'm going to get a letter. So this is every 50 paise. You see that the letters, each and every the letters are getting small. You can expand it, you get bigger letters. If you compress it, if you keep on compressing it, it becomes bricks. Ideally, it doesn't matter. The letters doesn't have any meaning. Letter A means I can easily identify that it is the first day of the letter. Letter B is second of the letter. Probably the letter F and G. I know that I'm in the middle of the day. Middle of the day is running out, and let me do a simulation on Reliance. So let me pull up. Let me go to Control Center. So Ninja Trader, there is a facility to control the. You can go and control. I'm going to disconnect my feed. I'm going to connect to playback connection. So playback connection is like a simulation. You can do real-time simulation, like how the market moves, and you can study how to approach any day. So I'm going to run the simulation on probably what simulation I can run. March 29th, I'm going to run the simulation. So the simulation is about to run. I'm going to start the simulation here. Maybe let me increase the speed. I think the simulation activity is not happening. Or maybe try to do some other day simulation. Let's take some random days, 25th. Yeah, 25th activity. So you could see that as the price keeps on moving, it keeps moving up and down, up and down. So we call that how the market is auctioning. You see that that particular day, price opens gap down on 25th of March. Right, so as the price keeps on moving, the letter hash, there was a small letter hash which is keep on ticking up and down, This is where the current price is trading. So now time is 9:45. The letter B starts. Right, so every half an hour, you know that when the letter is about to start, and it has started doing something like we call that as a price distribution is happening. Price distribution is happening. I want to increase the speed to 30x. What you're watching is the 30x speed. That means every second, 30 seconds of market data is passing by. And I'm going to increase a bit. So 50 times I'm going to run the speed. So now time is very close to 10 o'clock now. You could see here, time is 10 o'clock. You could see the price action activity, how the price activity is happening. So price went just exactly to the letter O. That means today's open. So today's open just only 1 point above it went, and then it started coming down. So those are the places where intraday players watches those levels, and then they trade the trading activity. And now the letter C started. You see how the trading activity is happening. The C is trading activity. The letter C, it went pretty much closer to the previous day's high. Hardly some 1 point difference. Only 1 point difference. It went there, and then it starts coming down. You see that what you can see in this picture is that you could see that the equilibrium point is getting built. Where the equilibrium point is getting built, the equilibrium point is getting built around the center over here. So that means maybe, I'm not very sure, but maybe this could be the day's point of control for the day. I'm not very sure. Now we see that now it is getting widening, A, B, C, D. Maybe this is the center for the day. I'm not very sure, but there are very, very high odds that more and more activity might be starting around here. We call this market as a balanced markets. A balanced market is where price keeps on revisiting a particular price again and again, and thereby it forms a center place where the price is it becomes the equilibrium point for the day. Again, now letter E formed. Again, you see that how the letter E is coming. It again comes pretty much closer to the same zone, and it's coming up. So these are the zones. Even if you are trading, you should know that even the price opens gap down, it's coming and revisiting again and again. So any deviation from the price all in a sudden could be your buying point or a selling point. And so if at all you're going to see a deviation, parallelly you also see the split profile. So there is a split profile over here. As an intraday trader, I have a habit of watching the split profile. I'm going to show you something interesting over here. I'm going to pass this. I'm going to show you something interesting in this example. So what you can see in this example is that, so the central level, what you're seeing here is called as the halfback. So you can see in yellow color line, which is the halfback, which is the day's halfback. This is nothing but the high of the day divided by the low of the day divided by 2. That is the halfback of the intraday. But then you can also see something, one more interesting example here. It's called intra-bar halfback, which you will be able to see from the split profile for the day. If you look into the split profile for the day, you could find even more something interesting over here. You see that there is a small white color line at each and every letter, a letter D. Right? You see that letter D, there was a small white color line. That is the letter D's, that is that particular half an hour's halfback. Somebody at E period came very precisely to that halfback of letter D, and then they are selling it. That's mostly intraday traders. Intraday traders are selling at the D period halfback. So there are many places you'll be able to see that. Again, you see the letter C. Letter C was exactly at the previous day's low. The previous day's low is the letter L over here. The letter L, you can see the letter L. The letter L is very close to the letter C. Somebody was watching that level and then somebody is selling from the day's high. So now I know that when more and more I'm seeing more visual references. So that is why you see that it's more of a sound. These days it's not a sound-based edge, it's more of a visual edge, it's more of a visual reference. Some people are coming this close and selling very close to this previous day's low. Do you think they are institutions, they want to come and sell exactly at the previous day high? Do you think they have time to look into all these information and taking a decision? No, right? It is mostly traders who look into those kinds of information. It is mostly the traders who does these kinds of stuff many times. How many times you would have seen that many traders will be waiting for the levels like 10,000 to break out or 11,000 to break out, then only I will enter. Many traders, they want that kind of confirmation. Many traders, they will wait at those visual reference levels. The visual reference level can be yesterday's high, yesterday's low, previous day's high, previous day's low, or something like a halfback, or something like a pivot points, or something like a 200-day moving average, or something like a trend line breakout. Every trader, some form, they have some sort of a reference level. That is what most of the traders, they care about. Most of the traders, they care about their entry points, they care about their exit points, and they care about their stop loss, their targets. That is what most of the traders, they care about. Institutions, they cannot play the same way. Institutions only accumulate, they only distribute. They can only accumulate and distribute. They cannot play the buy here and sell there kind of stuff. Their activity is completely different. Yeah, we'll be discussing more intensive in our training program about how the institutions behave, right? So let me run this activity. Let's run this further. I'm gonna. You see that now. What I see is that I was seeing letter C period high. I'm seeing some intraday activity. Letter E period also I'm seeing intraday activity. So in that case, it's tough to go in that direction. If I go in the direction, it is very less profitable. I know that because more and more we are going to compete with intraday players here. It's very tough to be in their direction. If you are trading in their direction, you should be quick enough to get out of the trade. Otherwise, it's very vulnerable to trade in their direction or positionally to carry forward in their direction. You see that more and more activity was dripping down. Letter C, letter D, letter E, letter F. If you look into the volume on your bar chart, you will be seeing very less and less volume transactions. Means you know that volume is not big. So price is sliding down. It is sliding down very slowly and steadily. And letter C is exactly at certain level. And letter E is at exactly at certain level. I'm competing with more and more intraday players now. Volume was relatively running dry. So price was dripping down slowly. See again letter G, but exactly at the C period halfback. Now more and more intraday players are coming into the system. That is why I'm seeing letter C. It was players are coming and selling exactly at the previous day's low, and again letter E period exactly at D period center, and letter G exactly at the halfback of letter period F. This precisely they are selling it up. They are traders. We call them as a trading money. Trading money having the habit of coming and playing at the mechanical references. Yeah, you think about algos. Algos are what? One form of trading money. Algos doesn't come in the market to invest. Algos, they only look for short-term trading opportunities. They get in, getting in, getting out, getting in, getting out, getting in, getting out. You see how precisely they are reacting to the information. It could be algos or it could be short-term players, but waiting for that level to happen. So all of a sudden, you see that the day's low has been broken down. How many times you would have seen that? The day's low has been broken down all of a sudden. This is where more and more emotional crowd enters. This is where you see very high volume transaction happens. But if you think for a moment for the day who you competed. For the moment who you had competed, letter C period high, it was an intraday player. Letter E period, it was exactly halfback of some other letter D period reference. If you look the G period, it was halfback of letter F. Price was dripping down, volume was running low, and all in a sudden volume picks up and it breaks the day low. What was the day's low? The day's low was letter A's low was the day's low. That got broken by letter I period. When you understand this behavior, you know that now something crazy is going to happen. Like maybe all the internet players, as I said, they have the habit of betting, right? So they have been betting on the downside right from the morning till the mid of the afternoon. That is where the smart money comes to move against them, because this particular day is not dominated by the institutions. Institutions, they are not dominating here. When they are dominating, these are the places where institutions find themselves to accumulate in the markets. Right? So they would have been slowly accumulating. Now, once the accumulation is done, they want to move the markets. Right? So look into the other activity which happened on 25th of March. So they broken the day low, and then all of a sudden they started moving on the other side. So you see that initially the letter A, B, C, D, E was here. Now it was A, B, C, D, E, F, G, H. We call that as the point of control, the equilibrium point. You can see a brown color line over here. That is where the maximum activity was happened over here. Or a small black color dot. A small black color dot where more and more activity happened. So this is the equilibrium point. Price has the habit of, the equilibrium point is a dynamic thing. It rarely moves. It rarely shifts. But then again and again, what you can see there is that you could be able to see that as a place where more time the price used to come and revisit back. Price have the habit of revisiting back. It acts like a kind of a magnet. It comes again and again to the same destination. Like say that now the letter K got back into the same point of control. Throughout the day, it was dripping down. Till letter C period to K period, it was dripping down. Time was 4:45. More activity happened over there. And finally, from 26th onwards, they made the move. More trading money came to play at what level? Letter D, letter C, letter E, and letter G. It's almost L period now. So we know that this particular day we competed more and more with intraday player, or could be ideally they are trading money. Trading money can be intraday activity, or it could be some short-term activity. If you know the behavior, it's very, very tough to go in the direction against them. So this is a place where the trading money is selling and selling and selling and selling and selling. They're getting the inventory of short-term players or intraday players. They're getting long to too long. More they are coming and selling, more the behavior you're able to spot from the profile, more the possibilities are there that market could completely move against them. Most of the intraday players are weaker hands because they are, especially the one who is coming at mechanical reference. More the players are coming at those visual levels. market has the habit of revisiting those levels. Sometimes intraday perspective, sometimes from a positional trading perspective, it revisits. So by reading the behavior, you'll be able to say what could happen and why it should happen. What could happen, you can read it from any kind of profile tools, any kind of indicators. But why it should happen, why the price should move against those things, you'll be only if you're able to understand that it is done by the weaker hands. The entire downtrend is done by the weaker hands. Think about the next day's behavior, the 26th behavior. What could have been done? Maybe every player would have been trapped the very next day. We stopped and then so the very next day they straight away took an up drive. So we call that as a drive in the markets. It took a complete drive and it completely, you see how the price is moving away from that. So maybe all the players who were the trading money, who were shorted are, maybe it could be intraday trading activity, or it could be some sort of small trading activity. The small traders behavior, as I said, they wait for the reference level to take a trade. Right, so price is now completely moving against them. That is what market does again and again, most of the time. Not every time, but most of the time, market has a habit of doing that. Now again, you look at the B period. The B period was exactly came to yesterday's high. Yesterday's high was a C period high. Came just 1 point away from that. Maybe some trading money could be involved over there. So all you have to take is a combined information to understand the traders behavior. The same activity is not going to happen. The activities happen on 25th. You may not see the same market activity there, because when the price moves like this, maybe some of the traders who got stuck yesterday at those levels, those exact levels, they are the first one to cover, because they are small traders. They cannot afford for a bigger stop loss. So they are the first one to cover. When more and more people are covering it, that is why it results in a short covering rally. Maybe it could be a short covering rally. You could have been able to anticipate such kind of short covering rally if you know what kind of participation happened yesterday. Yesterday's activity, people came at the 3 reference levels. All are intraday levels. Most of the intraday player watches, or some small traders or some short-term traders watches those levels. They are precisely playing there, and price is now moving completely against them. Right, so that gives you the confidence that more and more now you're able to reason that the small traders who went on shorting yesterday, they completely got into a trap. Probably at times you'll be able to anticipate that this could be a trap. In real time itself, you know that it's tough, it's dangerous to trade in against them. If I split the profile, I can split the profile over here. And you could see that it's very dangerous to go in line with them. The price was dripping down and down and down. It took the day low also, but it's very vulnerable to trade against them, because everyone is trading money. Market always have the habit of punishing those traders who are behaving very mechanically most of the time. But if you're seeing more and more weaker hand activities happening in the markets, you'll be able to spot out why the market move should happen and what is happening inside the market. That is what I'm saying. If you know what is happening inside the markets, there are many times you'll be able to say or probably kind of on forecasting why the short covering should happen, or what is the risk involved. You'll be able to assess the risk. The key risk is here is that all are intraday short sellers, or all are some sort of small traders. Today they will be doing long, tomorrow they will cover their longs or exit their long, or even they go short, or today they're going short and tomorrow they will go long. That is the short-term players' behavior. Those behavior, you'll be able to track it out on day-to-day basis. It's a continuous activity. So now you can see that the point of control was building over here, A, B, C, D, E, F, G. It's building around the center. So means more and more crowded activity is happening. Yesterday, the crowded activity happens over here. Now that crowded activity shifted higher, shifted above previous days high. It's a good sign. It's a good sign. Probably something has been changed in the markets. Yesterday there was equilibrium point built over here. Now today's equilibrium point is building above previous days high. Maybe it's a high confidence market. In a such high confidence market, it's better not to short. In the market itself showing high confidence, what not to do is more important than what to do in the markets. If you know what not to do, then most of your bad trades will get eliminated. Probably the indicators will not tell you what not to do. It will tell you only what to do in the markets. Or it will not tell you how risky to short this kind of markets, because market itself feeling high confidence. The buyers are driving the price up. The buyers could keep driving up. It doesn't matter whether the RSI is overbought or oversold or not. As long as the buyers are there in the markets, they keep driving the price higher and higher and higher, regardless of no matter what. Right? And that's the vulnerability. If you know that what kind of confidence is there, at least you would not shorted markets. Because more activity built where? Here is the activity built over here. Here is the activity. It was building above previous days high. See, more and more activity was building above previous days high. And markets are not willing to even come down below the previous day's low. That is the risk I'm talking about. It's a risk for short sellers, because markets are showing, the buyers are showing confidence. When the buyers are showing confidence, they are able to build activity above previous day high. More time price is spending above previous day's high. That is a high confidence buyers. They initially took a drive. That drive is one form of confidence. After taking the drive, more activity was happening around that level. That is again one more sign of confidence. That means buyers are still not interested to coming down. So it is a repeated, it's a continuous process. You have to keep on recording this market confidence. So what I'll be teaching in the Tradesla 2.0 is how to read the confidence, so that you can handle any kind of trading day. Let it be a big gap down day, dull, boring day, sideways days, highly volatile days. The framework applies. I would not say that it's a holy grail, but it is one of the best class mechanism for a professional trader to watch the markets, to read the markets, to understand what is the reason behind those price movements. Once you're able to master it, that is where you'll be able to tell where to enter and where to exit. Just because looking into the profile charts, you're not able to take a trade, because most of the trading decisions are happening, are happened during live markets. It will happen only during live markets. And there are places you could see that single prints, see some sort of a single print. We call that as a single print, letter I. See that letter I was not revisited. Only one letter got generated, only one TPO at the center. We call that as a single prints. We call that as what? Single prints. It's not initiated by some weaker hands. Maybe it is done by some long-term money, or probably some intermediate money. Probably some institutions might be controlling that. And those reference levels are very much important, because that could be acting like your support or a resistance band. Immediate resistance or immediate support. So in this case, it is immediate support. Again, look into the letter K. Letter K is also, there was some sort of a single print. Only one letter got traded. Only one TPO got traded in these bands. Whereas these bands, if you see, 3 letters got traded. Letter I, J, K. Whereas here, only letter K was there. So the letter I and letter K are pretty much important reference level. For me, it's an immediate support zones for the next trading day. So by looking at this information, I know that these are the points where some parties of interest they entered. That is the reason it's creating single prints. Right, so single prints, those are the zones. And next time price is coming to that level, then maybe if you are seeing that price is again exactly jumping from there, it is done by, those trades are initiated by the longer hands, long-term players, or bigger money, maybe institution money. Institution money might be defending those single print zones. If they are giving up those levels, if more activity started happening down these levels, then it could be a different ball game. Maybe something is changing in the markets. Something is changing. Maybe you have to react to the change. It's not the same old game which is playing. Previously, market was keep on going up and up and up. Now, market started building activity. The more activity started building below this single print zones. That means something is changing in the market. Maybe you have to learn to react to the change. First, one thing is learn to identify what is change into the markets compared to yesterday. Are we the same uptrend is continuing, or if at all there is a change in the markets, how the change could come? That is what you have to prepare in the pre-market session. Pre-market, before the market opens, we'll be preparing where you could see spot a weakness, or what the market could do, or why it should do. These are the reasons you have to cultivate yourself as a trader, right? And that's a habit. It should come as a habit. It should come as a habit, and that requires a bit of practice, right? So let's get back to the charts. I guess now you have a fair understanding how the market profile works, and how we learn to read from those market profile activity. And every day it's a different day. Every day it's like a puzzle. Market throws the puzzle, and your job as a full-time trader or a professional trader is to sit and solve and make use of those information. By knowing those, but first you have to learn to know what is the information I have to read. Then only you will to take a decision. Without knowing that, just by looking into the letters, you cannot take a decision. First, you need to know what is the behavior which is going on. Without knowing the behavior, it's pretty much difficult just by relying on intuition-based game or level-based game. Many people play the level-based game. So there is a value area. So buy above this value area. People does that. Sell below the value area. They does that. A price comes to the point of control. They buy. Price goes to a certain level. Price goes to previous day high. They will buy it or sell it. It is as good as trading the price-based indicator. Again, you're watching some level and you're expecting the price to do this. Right. So rather than getting obsessed with price, try to look price along with price distribution. Look price along with the point of control, the center point. Look price along with the combination of volume area, how the volume got transacted, where the more price is spent. And that has to come as a habit, right? That is what it's going to take a little bit of time. Now come back to the slide over here. I'm going to disconnect the feed. I'm going to disconnect the playback. I guess playback is a very interesting tool to study market profile and order flow kind of charts. It is as good as reading your 30-minute charts. So what on the left-hand side, what you're seeing is the 30-minute candlestick charts. And the split profile, it exactly replicates the same thing. If I compress everything, what I'll get is a market profile. Every day I'll get a distribution. And these distribution can be compared with normal distribution. I guess in your college days or during your high school studies, you would have came across normal distribution where the center is the 0 point and you get an 1 and minus 1 deviation, which occupies 68% of the area. So this is a probability distribution curve where most of the occurrence happens around at the center, 68.2% of the time. That is a 1 standard deviation movement. The same 1 standard deviation movement, if I'm able to plot in the profile in terms of number of TPOs, where 70% of the trading activity, right? So 70% of the TPOs, 70% of the TPOs. If you are able to spot in terms of percentage terms, 70% of the TPOs, roughly, rough estimate. That's what most of the tool does. But still, you have a software control to vary it. The ideal control is 68% of the time. So 68% of the TPOs. Same 68% of the TPOs. If I able to plot in terms of number of TPOs from the center, where the 70% of the TPOs got traded, out of the total TPOs. Let's say there are 100 TPOs. The goal is to find where 70% of the TPOs are getting traded. That has been taken care by the software. You don't need to worry about it. So there is a small bracket which shows that where the 70% of the activity is happening. That is called as a value area. So value area itself, it says like where more trading activity is happening. You could see that the edges, there are very less trading activity happens, but 70% of the trading is where most of the one standard deviation activity, where the one standard deviation activity is happening. So the market profile can be compared with normal distribution. And what it says is that if at all the price is moving away from the one standard deviation movement, then you can expect the price mean reversion towards the equilibrium point. So the equilibrium point is as good as we call it as a point of control. Or we can also say like it's a fair place where most of the people are interested in doing business. It's a couple of basic market profile terminology one have to understand. One is the initial balance, point of control. Initial balance is the first 1 hour range. That is nothing but the high and low of letter A and B period. The point of control is where more trading activity happens. Right? It's also called as a fair place to conduct a business. Value area, which represents the one standard deviation of the price activity, which is nothing but the 70% of the trading activity in the TPOs. Right? And we also seen the buying tail and selling tail. Buying tail is always at the bottom and selling tail is always at the day's high. We also looked into the single print. Single prints is what? There are certain places where only one trading activity happens horizontally. So if you look into this example, there is a couple of zones where you can find the single prints. These are single prints where only one letter is happening horizontally. If you see horizontally here, almost 8 trading activities happening. Almost 4 trading activities happening horizontally. Here only one activity is happening. Wherever one activity is happening, at times in the lens example, The Reliance example, we've seen letter K and letter L. Single prints are happening in between the profile also. So single prints can happen in between the profile. Single prints can happen at the tails, right? So those are the places where you can say that those are interested zones where less volume, less the TPO got traded, less the volume also got traded over there. More the time-based activity, more that results in a volume activity also. So you could see in this example, you could see more time is spent in this band, and you could see that more volume also happened in this zone. So and that gives you meaningful information that helps you to derive a support. Probably these are the places where institutions might be accumulating or distributing or doing something else. If you're not finding any weaker references, maybe the smart money might be accumulating slowly or distributing. They might be doing something else. But it is always a combination of information. We will not rely on only one information to take a judgmental decision. What happened yesterday, what is happening right now. So it is a combination of what happened in the past and also what is happening in the present. Combinedly, one will be taking a joint decision rather than looking into one information alone and then taking in one, thinking that, okay, this is weaker level, okay, go for a short or go for a long. It is not that it is not like that. One will be taking a joint decision, by reading the sequence of market generated information and thereby taking a cumulative, read the entire cumulative information and then combining it as a whole, take an bird eye perspective and then truly understand what is happening inside the markets, then we take the decisions. And that is a skill, right? So that means it can be learned. So the initial balance, you can see a small stripe there. So any days you will be able to see a stripe, which is nothing but the first 1 hour high and low, as good as the open range breakout. So many people does the open range breakout. It is not advisable, right? But yes, good to know the initial balance, because when the market opens, who flood into the markets every day? Who wait for the market to open? Can anybody put in the chat comment? Who wait for that? Do you think long-term players, they wait for the market to open and then the opening itself they want to buy? Who really waits as a crowd? Who really waits the market to open? PTST players, intraday players, retail players. Ideally, they're trading money, right? So in short, we can call them as a trading money. The trading money is the one they'll be waiting for the markets to open. So the first 1 hour will be mostly flooded with the volumes, right? So when those volumes are made by the retails most of the time. Yeah, at times if there are events, some smart money might be coming for the play, or at times, but most of the times, first 1 hour activity will be dominated by the trading money. That is why it is very much important. Do we create strategies based on initial balance? No, right? But it's good to understand how the range has been built, who dominated there. If you're seeing that the first 1 hour range is built with low volume, maybe that particular day only trading money would have been there. But if you see that very big volume transacted in the first 1 hour range, maybe that day could be trading money plus some long-term money could be present in the markets. It is again, we are only talking about the trader's behavior over here, right? So again, one have to cross the phase to reach through the stages of various learnings. I'm going to show you one interesting example over here. Right? So first, let me go through the basics, and then I'll show you a very interesting example. And that's one of the classical signature trade as well. So in this case, you see that more trading activity happening at the center. We call that as a point of control or equilibrium point or a fair place to conduct a business. The day's high, we call that as an unfair high or an unfair low, because price is not spending more time over there, and it often have the habits of mean reverting back towards the point of control, right? So at the day's high or the day's low, we always call that as an unfair high or an unfair low. So what we are doing is we are doing a mentorship program for almost 30 trading days. And we are doing 20 days of live training, doing live markets to how to read, because every day is a different day. How you can able to understand the trader's behavior, how to able to understand the weaker hand money, how to understand the smart trading money, how long to wait, how to take those, which are the intraday trade setups, which are the trade setups which says that this is in place and intraday trend reversal is going to come. which are the place which says that intraday price have the higher odds of trending up or higher odds of trending down or higher odds of revisiting to a certain price level. Why it should revisit? The why is the reason we'll be focusing on more, and the traders' behavior is again will be focusing on more. We'll be again and again focusing more and more on traders' behavior, and it's a routine habit. The 30 days will give you an immense insight about how the traders behave in the markets. That way, and also it helps you to take advantage of those moves based upon what the other traders are doing. And we'll be closely covering 60 plus hours of live learnings. This includes both live training session as well as the weekend. Weekend we'll be having the theoretical sessions, and live markets we'll be practicing what we learned. And yeah, every day is a learning day to you, and it's closely 60 plus hours of live learnings. Everything will be recorded, and those access will be provided to you for next 1 year. And we'll be closely covering 40 plus intraday trade setups and positional trade setups. Some of them are scalping setups, some of them are intraday trade setups based on market profile and order flow. Yeah, at times it will be a combination of market profile and order flow setups. And there are certain places there will be classical signature trades which repeats very often in the markets. When I say repeat often, so that means in a month it will be repeating 3 times or 4 times in a row. There are certain signature trades which repeats every 6 months once or every 1 year once. So we'll be discussing all those intraday and positional trade setups. So there is a coupon code here for the viewers who are viewing currently. The coupon code is TXFWS. You can apply it on the trade action portal, and you can make use of those 10% offer. Or you can also connect to our customer support team. Here are the numbers. There are 2 numbers over here: 95351334445, 996547171, and you can talk to them. So the event was happening from April 6th to May 6th. The complete agenda, you can go and look into the agenda. If you haven't gone through the agenda, it's a very intensive agenda. You can always go to marketcalls.in, go to Tradezilla 2.0 portal, where the complete agenda, complete what we are going to talk about it, what we are going to cover, everything will be covering from the trader's behavioral perspective, right? So that is the ultimate key for getting an edge. What most of the people misses those information. Very few people care about this information. So we'll be having a couple of sessions on. Here is a complete working schedule. So weekends we'll be having webinars, and live markets every day we'll be spending closely 1 hour. So totally we'll be spending closely 60 plus hours. So we have a schedule on week 1, week 2, week 3, week 4, week 5, and if there will be special sessions also conducted. If there is any event, something like an RB announcement, even if there is any such kind of events are happening during those markets, we'll be taking again additional session on those event days. And the topic has been classified into market profile basics. We'll be starting everything right from the scratch, and we'll be completely covering all those setups on market profile basics. And again, market profile intermediate, we classified into certain set of topics, right? So there are here we'll be talking about complex patterns, complex reference levels, certain reference level which have the habit of revisiting again and again. And there are a couple of advanced setups where we actually discuss the trade setups. Finally, the trade setup is where we'll be discussing. Finally, yeah, we'll do side by side, but we'll also take in one stretch of sessions or two sessions to explain the setups. In terms of setups, what are the setups you can anticipate? What are the top and bottom formations, and what are the positional trading zones you have to weed out for? Are the 30 plus intraday trading techniques. And we also organized a session on NinjaTrader 8, because from the past experience we learned that people also want to learn NinjaTrader 8 as a platform as well, and they want to know how to do the profile settings, how to set the TPO size. They want to know, and the indicator settings, the scanner settings, the dynamic profile setting. There are many settings people want to know about it, and how to use bell trend analyzer with G2, G3 patterns. And then this is only about market profile. We're also covering order flow extensively. And this is mostly for intraday traders and scalpers. And we're also going to explain how to combine market profile and order flow to take an cumulative decisions. So we'll be starting again order flow right from the scratch. We'll also be discussing more intensively on order flow patterns, and some of the patterns are closely associated with market profile. right? So we in order flow we'll be closely covering 10 to 12 setups from an intraday perspective, right? So most of them are trend following setups, moment of exhaustion setup, mean reversion setups. So it's very dynamic. It's for the people who want to learn to swim through those any kind of market situations, right? So ideally, that's what the core focus is, to learn to trade any trading instrument. Let it be Nifty, let it be gold, let it be crude. But most of the examples we'll be spotting out on Nifty, Bank Nifty, and a couple of stocks. We'll be taking some bunch of Nifty 50 stocks, and we'll also be taking examples from Nifty and Bank Nifty, and then we'll be monitoring it during sessions. We'll be taking a lot of case studies, a lot of inputs on the sessions, and that's what we're going to cover it up. And this happens from April 6th to May 6th, right? So it's almost closely 30 plus days. So let's come back to the topic. So based upon different levels, based upon a different price, we'll be setting up different setups. Right? For example, for Nifty, the price range is between 5,000 to 30,000. I'll be using a 1-point TPO. I'll be mostly using 1-point TPO to identify the pinpoint levels. To identify those pinpoint levels. So 1-point TPO. So in my software, I'll be using a setup of 20. That 20 will be multiplied by 5 paise and it becomes 1-point TPO. Means every 1-point movement in Nifty, I'll be watching out 1-point TPO. So something like an Ashok Leyland. Think about Ashok, something like an R-count. If the price range is less than 100 or if it is coming in this range, we'll be adopting appropriate setups in our software tool. Accordingly, we'll be looking for, if it is something like an R-count, we'll be using 5 paise TPO. Every 5 paise, a new letter will be born. Or something like an Ashok Leyland, or something like an ICICI Bank, we'll be using 10 paise TPO. Or something like a Titan or Reliance, we'll be using 50 paise TPO. So these are optimal settings. I already explained in one of my article how to set those setups. We'll be discussing in detail about in the session how to do those settings. Right. So the same settings I cannot do it for Nifty. I cannot apply a 5 paise TPO. I can do that, but it will generate more information. It's the same information, but I'll be looking into more and more information. It's very tough to digest. So the settings which I provided here is an optimal settings, which will help you to read the profile chart with the maximum information, where most of the visual information can be easily able to go through such kind of visual information. It's pretty optimal to read those where intraday players are entering. I can use higher. Some people for Nifty, they use 3-point TPO or 5-point TPO, but they cannot be able to focus on where the intraday players, what the intraday players are doing, or whether they are weaker hands, at what level the weaker hands are entering. It's sort of to say. So the optimal points which I given you, which helps the traders to enhance and then closely look into the finer details of information. We call it as a market generated information. They'll be able to learn through that. And market itself, one can classify into at the broader level. We can classify into different types. The scalpers are intraday, short-term traders. Scalpers and intraday traders, they get in, get out, get in, get out, and mostly they close all their positions by the same day. They don't give a solid commitment to their positions. There are short-term traders. They'll be holding for 1 or 2 days or 3 days. Probably most of us, including me, I'm also a short-term trader. We do have a habit of carry forwarding the positions hardly for 3 to 5 trading day sessions, or maximum 10 to 15 trading sessions, right? So that is what the typical short-term traders they belong to. So 70 to 80% of the short-term traders, they belong to holding period anywhere between more than a day to up to 15 trading sessions. Mostly they'll be looking for some short price action move, and then they'll be unwinding their positions. They don't give a commitment. But when it comes to intermediate or long-term traders, they are the one who give solid commitment. When they are entering up, when they are piling into the markets, they give a commitment for next 3 months, 6 months, 1 year, or more than 1 year. That's the kind of flow. They are mostly institutions. They are mostly institutions like FIs or DIs. And most of the clients, 70 to 80% of the clients are mostly scalpers or intraday players or short-term traders. We call them as a trading money, right? And at times even the institutions, they also come at a certain reference level. They also watch certain levels. Maybe the institution might be watching a different level. As a trader, they'll be watching today high, 2-day high, 3-day high, or where is the 5-minute moving average, 200 moving average, or where is the hourly moving average. our 10-day moving average and 20-day moving average crossover on an hourly charts. That's information the traders watch, whereas the investors will be watching different levels. They might be watching 52-week high, 52-week lows, or probably they'll be waiting for the breakout to happen on a weekly breakouts or a monthly breakouts or quarterly breakouts. Like so, they're everyone watches some sort of levels, but according to their time frame, according to their risk-taking ability, different people, according to their holding period, different people watch different time frames. But there is a habit. There's a habit to that. Right? So it's a repeated habit which found in almost every other markets. It's the same behavior which is happening here in Nifty. The same behavior will be happening in some other markets also. So we are discussing about the point of control. If the point of control is more than 10, we call it as a prominent point of control. Or a very prominent point of control if it is more than 12 or 13 TPOs got traded. So we are going to see a prominent point of control. It often have the odds of revisiting back. And one of the levels which I'm going to show you, it's a prominent point of control, and it's kind of a signature trade also. So I'm going to show you the example from Bank Nifty. Let me show you the example from Bank Nifty here. I think I have to connect to the data. Let me connect back to the data here. I'll go to Control Center. So Control Center, from there I'll connect to the data. I just want to show one interesting setup. Okay. So this is Bank Nifty April contract information. Bank Nifty April contract information, and you see that one of the day on 25th March, you could see if you measure the total number of TPOs over here, you could find something interesting happening over here. So what was interesting, which is happening on that particular day, is that it is a prominent point of control day. That means more than 10 activity got traded. You see that letter A, B, C, E, F, G, H, I, J, K, L, M, almost 12 letters got traded. That means something interesting is happening over there. That some sort of a behavior is happening over there. Think about the very next day. The very next day, so here is the point of control, the brown color plot. Think about the low of the day on 26th of March. 26th of March, price came just 1 point or 1.5 points above from there. It exactly moved from there. That means more trading money is taking bets from here. More trading money is betting from here. That means 26452 is where the price moved, and price took a very big movement on that day. Price was almost up by 600 points. See that the price is spiking up. A lot of single prints. You could see that more players are betting on the longs. But ideally, who initiated the trade is 29,435. So these are very short-term information. They are not intraday information. They are short-term information. Some information are valid for intraday, and some information are valid for positionally. So this is one positional information which saying that positional traders are taking bets over here, and they are traders. They are not whoever initiated trades are not bigger money, but mostly some short-term money is involved. They taken the bets precisely, and always we call that also as a RPPOC. So automatically the software plots an indication saying that RPPOC. It's also called as a reversal PPOC, where price bounces precisely from there or just 1 point away from that. The price is bouncing back. We call it as an RPPOC. It bounces back exactly from the prominent point of control. It's a prominent point of control day on 25th. 25th is the prominent point of control day, and 26th price was leaving the station exactly from the RPPOC, or just 1 point away from the RPPOC, which is a sign that we are dealing this 600 points activity is initiated by the trading money. Trading money can do this big, but yes, but who is responsible for this? Do you think it's not done by FIs? They are done by, maybe even under the FIs, there could be some classifications of short-term players. Maybe even if the FIs would have been driven that, it could be some short-term money is driving that. Short-term money is driving that, maybe to protect their already their existing long holdings in call options or put options. They want to protect it. They're temporarily taking a measure to do that. So whoever taking a trade exactly at those levels have the odds of mean reverting back. I don't know when, but probably in a very short term, probably in the next series, we can expect a mean reversion towards 29,500 levels. Precisely, one can expect a mean reversion towards those levels. And in the past, these kinds of information have given a tremendous opportunity. I believe this time also it might give a tremendous opportunity. At this point of time, there are a lot of strength is present there in the market. I don't know when it could revert back, but when the price is reverting back, it gives a lot of signatures from the profile perspective, right? So, but with this, I can say that these are very high precision odds levels where the price could revert back. I don't know, maybe another 200 points, 300 points from here, we might revert back. But where to revert back, how to take a trade towards those levels. So currently, I think Bank Nifty is trading around 30,500 levels, the April contract, which means almost 1,000 points. 1,000 points of one can expect 1,000 points of price to mean revert back. That gives a tremendous opportunity to write the calls at this point of time. And one can keep writing out of the money calls or something like that. Or if you know precisely where the market could turn, if you don't want to. If you're willing to wait for appropriate bets to take, where the inventory is getting long to too long is where the place where one have to take a trade over there. At this point of time, not much of clues over there about the inventory, but yes, maybe you see again the more trading activity was happening over here. More and more short-term players are taking their bets here, and even here a lot of structure. The structure itself not looking good. We call that as a poor structure. More these kinds of activities happening. We know that more and more we are competing with short-term players, and short-term players they go long to too long. When they are going long to too long, that is where one can anticipate a correction. Probably that correction could go towards 29,400. You'll be able to reason why the price should have go towards 29,400 and when it should be able to go towards 29,400. That is the reason you'll be able to make out if you know what is happening inside the markets. If you know what kind of behavior is running inside the markets, right? But many basic traders, they do the same thing. Again, they buy above the value area, sell below the value area. That is amateur's game. A professional game here is trying to take advantage of the market generated information, thereby taking a better trading decision. Always the game is to play the game better, right? Not to look into the setups and then not looking for formulas. Understand the game, then you place the understand the risk involved in the game. Markets are always complex, right? So always you need to take, when markets are itself moving complex, you need to take decisions. Doing live markets is not going to be easy all the time. Sometimes it will be difficult, sometimes it will be easy. But there are certain times if the markets are pointing towards certain risk, probably you'll be better prepared. You know that when you want to go long, maybe you might be betting long now. You know that there is odds always on the downside. It could revert back. Maybe it's not good to go with a full force. Probably cut off your position by 50%. You can better prepare yourself. And when the markets are reversing, maybe you can have a better bet, better odd when the markets are showing better odds in your favor. You know to increase the quantity. You know when to increase, when to decrease your quantity. If you know what kind of players are behaving in the markets. And you'll be able to continuously adjust your positions as well, depends upon what the market itself doing. Maybe some sort of things you consider as a risk. So if you want to go for a long here, you find this as a risk, maybe you might hedge your position and then you go long, right? So because the RPPOC always have the odds of revisiting back. So in that case, you have the even if you feel that markets are bullish, you want to take a bullish opinion, you can consider that there is a risk down there. Maybe anytime market could drop down below 29,400. In that case, you'll be better prepared towards those risks. So you will not run your positions naked. In that case, you might be taking some out of the money puts to protect your long positions. So dynamically, it helps you to adjust your setups rather than blindly going with buy here, sell there kind of stuff. You'll be able to better prepare for what kind of risk in the future it could happen. Or if the market is willing to turn back, you can also go back and strike it on the directional perspective also. So it helps both the directional traders and non-directional traders as well in the markets, especially the one who want to truly understand what is happening in the markets. So I'm going to take you to a couple of profile setups, a couple of examples here. So a balanced market, something like, and we call that as a rotational markets, where more trading activity happens over here. We call this in balanced markets. An imbalanced market is like kind of a trending markets. The one what we are witnessing in the recently, all these are trending markets. All these are trending markets. The trending market, the profile shape itself very much elongated. Whereas the balanced market, we'll be seeing more distribution. We will be seeing bulged activity at the center. Probably it could result in the form of an prominent point of control or so. You could see more and more prominent point of control, and those reference levels will be automatically plotted. So what I'm using is Bell Market Profile Ultimate. It does certain levels automatically gets plotted. Some of them are places where it shows that. So these are some stops over here. Some stops are over here, and some short-term trading activity happens over here. 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 So I'm seeing a lot of short-term trading activity happens in this band. Yeah, it is also a combination of short-term activity plus long-term activity. Because long-term activity, because I'm seeing a lot of single prints over here, and some long-term activity happens in the past. You could see some sort of a spike with a lot of single print zones. Some spike with a lot of single print zones. So these are places where long-term activity is getting generated. Maybe these are the places where the FIs are driving the markets. Right? Maybe now more and more long-term activity is happening, and along with that, I'm seeing more short-term activity. The more the short-term activity I'm going to see, more the odds of price coming back and revisit those levels where the short-term activity is taken out. One such level is the 29,400. Probably we'll be watching it pretty much closer in the upcoming days, the 29,400 levels. I'm not saying that immediately in the market could do that. I don't know when it's going to do that, but when it is doing it, will give me a lot of signatures. Probably in the Tradezilla 2.0, we'll be discussing those levels. We'll be monitoring those levels pretty much closely, maybe after RBI announcement or one day before RBI announcement. We might go and touch those levels. But we might have a pretty good idea when there could be a change. We'll be able to recognize those change and we'll be able to trade towards 29,400 levels. So I'm gonna, there's one more concept called range extension, where the IB breaking out, we call that as a range extension. I'm gonna skip towards the tails. The top tail is called as a selling tail because that is a place where the buying activity ends and sellers take control. And the bottom tail is also called as a buying tail because that is where the price keeps on going down and down and down, and sellers get exhausted, right? And sellers lose their control, and thereby buyers taking control from them. That's why it's called as a buying tail. And most of those tails we call as single print tails. So most of the tails are single prints. It lacks horizontal activity, means vertically if you see there'll be only one TPOs, and very rarely it goes to 2 TPOs or 3 TPOs at the tail zones. So the profile distribution, there are many different profile types you can see, but repeatedly it comes under this classification: a non-trend day, normal variation day, trend day, double distribution day, neutral day, P-shaped profile or a B-shaped profile. And each profile distribution has a different set of meaning. It tells who is dominating, whether it is initiated by the trading activity or it is initiated by the longer time frame activity. It tells the behavior of the traders at the very core level. So these are the core principles on how to learn it. It will not help you from a trading perspective, but it will tell you, it explains the trader's behavior. It will not tell you whether the markets are bullish or bearish, but other than bullish and bearish, it tells a lot many things, which is missed by most of the traders. So one of the very first example is the non-trend day. Non-trend day, you'll be seeing that initially first 1 hour, it will be dominated by the traders. The IB range, the initial balance got formed, and more trading activity happens inside the IB range. So more trading activity happens inside the IB range. Volume will be dull, volume will be boring, price activity will be boring. You can feel the dullness boring throughout the day. So those are the days are dominated by the intraday traders. Higher time frame traders are not in the markets. When higher time frame traders are not in the markets, you will not even find a day's breakout. That particular day range, which is established in the morning, that itself not get broken. Typically, it ends up like an inside bar. Those are the days where there is no confidence prevailed in the market, neither from the buyers, neither from the sellers, because higher time frame activity, the long-term trading activity, or the short-term, even the short-term trading activity might be mostly missing. Only intraday players might be controlled, or some trading money will be in control, especially one day before the event or any major announcement is supposed to happen. Volume goes down, and thereby the only intraday players take control in the markets. Not much of long-term money might be present in the markets. Long-term money might be present. FIDs might be doing something else, but they are not dominating. Who is dominating more in the scenario? Only traders are dominating the scenario, and the traders, they don't have the muscle power to move the markets. Who has the power to move the markets? If it is Nifty 100 points, as short-term players can move the markets. An intraday player cannot move the markets by 100 points. An intraday player alone cannot move the market by 100 points. Or a short-term player alone, they cannot move the markets by Nifty by 1,000 points. If somebody wants to move the market by 1,000 points, without long-term activity, without intermediate activity, they cannot move the markets. Right? So the non-trend day typically explains that it's a dull, boring moment, no IB breakout, no initial balances going to get broken out, tight range, low volume. That means serious money is missing from the markets. Only traders are in control. Probably if you learn to know that, you can stay away from the markets, because you'll be seeing that the point of control is widening. It's widening with very less volumes, and that means no serious traders are there in the market. When there is no serious traders, there is no serious trading opportunity as well. So you learn to wait, right? So only traders are competing in such kind of environment. Better not to compete with them. Most likely nothing is going to happen unless some change happens. If there is a change, there will be an opportunity. What is the change? You have to observe that it pretty much closer. There maybe the change might come by breaking the day low. All of a sudden it breaks the day low and it bounces again. It got back into the range. That is a buying opportunity. Or probably all of a sudden they break the day high and then they got back into the range again. That is a selling opportunity. That means those are the places where the confidence changes. There was a no confidence. No confidence means no trades. Strictly no confidence. The market itself not showing the confidence means you try to take an opinion, hardly it turns out to be a 50-50 game. Either you may be right or you may be wrong. But if you want to improve your probability, if you want to improve your odds of turning success in your favor, then you have to learn to wait. Those are the environments you should not compete in the markets. There are many places you should not compete in the markets. One of the thing is that if you're seeing more activities happening inside the range, dull, boring activity, no breakouts are happening, you have to learn to wait in those places. So you're seeing activities widening, point of control is building, dull, boring days, one have to wait. The next comes the normal day. So this is a typical day you're going to see in most of the trading sessions, where the initial balance, the IB, got broken out on one-sided. And then, yeah, it provides some trading opportunity. So it mostly provides either trending or mean reversion trading opportunity. These are the days where 65% of the time you'll be seeing a typical bell curve shaped profile. Most of the trading days are normal days. And those are days sometimes IB breakouts are profitable on such kind of days. Where maximum participation happens at the center, probably the day's point of control will be widened by almost 7 times, 8 times, or 10 times, even 12 times or 13 times. The first 1 hour, there will be a wider price action. That's how the typical normal day looks like. So it doesn't mean any bullishness or bearishness, but it's kind of one form of profile distribution, how the profile distribution could form, what are the ways it could form. Then finally it comes the next level of learning, again the next level of learning. Again and again it talks about the participation behavior again and again. Next comes the normal variation day. These are pretty rare. I would say that 20% of the time it occurs. Yeah, market trends only 20% of the time, right? 80% of the time it will be dull, boring, it will be balancing, it will be market will be doing sideways. And 20% of the time you could be seeing this imbalanced profile or a trending profile. Right, so market will be balancing in the first half, second half will be breaking out, and then so these are the days IB breakouts will be profitable. Those days, that means only 20 to 25% of the times your IB breakout is going to be profitable. Where the range extension happens, price breaks the IB, we call that as a range extension, and then it takes a directional movement. This is where the intraday players can go and play the initial balance breakouts. And typically the first half an hour will be mostly dull, boring. You won't find a volume. Volume will be coming mostly in the second half. Second half volume piles up. higher time frame activity happens in the second half. We also call that as an OTF. OTFs are entering. That means other time frame traders, bigger traders, or possibly the traders, they're not trading money. They are entering into the markets and they are pushing the markets towards a different level, right? And more trading activity happens on the day on the higher side in this case. So here a directional breakout is happening. And that means that those directional breakouts, you can, from the behavior itself, you'll be able to see that. You see the letter J and K, L and M period lows, you can find a greater distance between the levels. Those are the places where you know that they are higher time frame players. And when small time frame players are moving the markets, you'll be finding this close. Probably between one candle to another candle, you'll be finding this close. You won't find much of a difference. Price will be moving up. But when long-term activity is coming and taking dominance, you will be feeling the difference. The difference will be like they'll be moving like this. They'll be pushing the market in a different way altogether. You could find that the lows will be having a greater distance, and the way they move the markets will be pretty much faster and with the heavy volumes. Whereas when small traders are taking control, low and low volumes, they'll be able to move up still, but it'll be like a snail. They'll be moving slow and steady for the day. So those are the days you'll know that these days are controlled by the intraday players. And again, coming back to the point here, there are many cases. This is one of the day, trend day. Typically, it happens once in a month or very rarely twice in a month, right? So we call that as a one-time framing. One-time framing is one form of a market confidence, right? So who is doing the one-time framing? It matters. How the volume is going when the one-time framing is happening, it matters. When one-time framing is coming up with a very steady volume supply, like every other 5-minute candle, you are seeing 3,000 lots, 2,500 lots, 5,000 lots in Nifty futures. That means some higher time frame is involved and price is one-time framing. Those are the days you know that the volume is pretty much good. Price is one-time framing. One-time framing is one sign of confidence where the price keeps on making higher lows. Even the previous lows never got broken. Not even only, very rarely, only once it got broken. So the B period lows are not broken by C period lows. The C period lows are not broken by the other period lows. It keeps on making higher high throughout the trading day, right? So that is the characteristic. That is a true characteristic of trend day. That happens rarely once or twice in a month. It's 3 times in a row or twice in a row are very rare. Very rarely it used to happen. Those are the days where you can find that long-term players or intermediate players are present in the markets, right? So the structure may be looking like poor. We don't consider that as a poor structure because higher time frames are involved. So maybe their interested parties are entering into the markets. So those are the days you'll be getting an elongated structure. Those days you don't find even there is a point of control formation. You'll say like nobody is in control in the markets. But many short-term players, they have the habit of trading against those trends. Most of when the people are seeing this one-time framing, people have the habit of betting against the trend, hoping for the trend to end. But when these are the places, you need to understand that you're competing with stronger money. More that one-time framing is happening throughout the day. As long as the one-time framing is not ending, price is not balancing, it's tough to take a mean reversion bets against these smart monies. If smart money is flowing, one should either stick to the position or stay away from the position as much as possible. And next comes the double distribution day. This is also one form of a trend day where we have a balance. The balance one here. This is the balance one, first balance, followed by a single print. The day will be separated by a single print, and again you'll be finding one more balance. So 2 balance are separated by a single print. So we call it as a double distribution day. It is also one form of trend day. It is also one place where long-term players or intermediate players are taking control in the market. Those single prints indicate the presence of higher time frames, right? So some bigger time frames are coming in and betting in the markets. Maybe those levels are serious levels. Maybe you have to treat that level as a different level. So one can take references, kind of a support or resistance. You can take it for monitoring, for positionally, and at times intraday also those levels makes a lot of difference. If you know what those levels from an intraday perspective or from a positional trader trading perspective, one can take advantage of those at those levels. And next comes again, it's very rare, hardly only when long-term money is flowing, you'll be finding double distribution or a triple distribution. At times, very rarely it extends to a triple distribution or even multi-distribution days. Those are very, very rare. Hardly if you take last month you might find some 2 to 3 double distribution patterns in Nifty or Bank Nifty. That means some bigger time frame activity was involved over there. When you're seeing that, it's hard to bet against those directions. Here the price direction was up, so it's tough to bet. Most of the time it's going to be turned into a bullish mode when you're seeing a double distribution pattern. The very next time price have a tendency to fall towards those single print zones, interested parties they come and accumulate again over at those locations. You'll be able to visually see that levels. And next comes the neutral day extreme, where the initial balance, the first 1 hour range, got broken on both the sides. The lower side also you will see a IB breakout. Upper side also you will see an IB breakout. And IB breakouts happen on both the sides. This in a month at least you'll be seeing these kinds of patterns once or twice in a day. You're going to see these kinds of patterns, and it repeats very not often, but at times it repeats at the market tops when the markets are nearing some events, and you're going to see these kinds of neutral extreme. It could be one form of a market top. One day before it forms such kind of patterns before the markets are topping out. One can find these kinds of patterns. But in this case, the neutral day extreme, the first half an hour will be dominated by low volume, and lately the second half volume intensity increases, and then the higher time frame players comes in the second half. The volume started flowing in the second half. Right? But if you look at the distribution breaks the first half an hour high and low on both the sides, and price close at the one of the extreme. That's why we call it as a neutral day extreme, where the price close at the one of the day. And neutral day center, it's kind of a confusion day. This also happens once or twice in a month, and it also gives tremendous intraday opportunities. We have a couple of setups. You can anticipate these kinds of neutral day centers or neutral day extreme kind of patterns if you know the volume behavior. And so these are the places where again the first half will be dominated by low volumes and second half will be high volumes, but the day closing will be mostly at the center. The price closing mostly at the center, and kind of a confusion. Both higher time frames would have been present on both the sides. The long-term money would have been present on the upper side also, on the downside also, and nobody was able to move the markets in their favor. So market closes at the center. Again, the P-shaped profile. P-shaped profile is one of the strong indications that new money is coming into the markets. At times, P-shape indicates only short covering. Old money gets covered. At times, it is a combination of old money plus new money, new fresh long-term money is coming into the markets. At times, when you're seeing it, you could find that P-shaped profile. Last month also we had seen Nifty was coming down and then it was balancing. When it was coming up, it comes up with a P-shaped profile. That means those are the indication that fresh long-term money or fresh higher time frame money is coming up. And more price started trading above P-shaped profile. So those are the indications that fresh money is coming into the markets. So you better try to stay away from trading against those fresh, bigger money. So for example, I can go back to the charts and I can show you how the P-shaped profile happens in Nifty and the Bank Nifty last series. And of course, I can show it in the March series, but April more or less replicates the March behavior. So 15th of March, you could see that pattern. 15th of March in Bank Nifty, you could see that P-shaped profile which happened over there. At that levels, it brings more interesting levels. That there is a P-shaped profile. That means more fresh money is coming in. Already some smart money would have been already played. Some long-term money was there. Now more fresh money has been pumped into the markets in the form of a P-shaped profile. P-shaped profile always starts at the top, bottom. It establishes a low and then it moves up. There will be a short covering rally followed by a P-shaped distribution at the top. Similarly, B-shaped profile, it's a kind of a liquidation pattern where price drops from the top. It drops and the balance happens at the lower end. So it's mostly the B-shaped profile is an indication that old money is getting out of their longs. It is not necessarily short. Very rarely a B-shaped profile could be a combination of, very rarely in a bull market, if you're seeing a B-shaped profile, it happens, it comes with fresh short positions, but mostly it is only liquidation of old money which is already long. Maybe they are booking their profits. If you're seeing B-shaped profile in a good bull market, that is a sign that old money is closing their longs. Maybe there's some sort of a profit booking, or maybe some before some event they're liquidating their positions. Some long-term money would have been involved. They might be doing some inventory adjustment. They might keep on buying and buying and buying. At some point of time, they want to book some profits, and later they want to add at different locations. They want to add it up. So in those locations, you'll be going to see a B-shaped profile. They are not fresh shots, but mostly they are old money closing their long positions. So again, this could have been done by not by intraday players, not by trading money alone. Some sort of higher time frame would have been involved when you are seeing a B-shaped profile. Again, this is not part of a pattern, but yes, a spike is one form of an profile type. It is not a profile distribution type, where you could see some late reactions in the market, late rallies. In the last 45 minutes, all of a sudden price spikes up or spikes down. Last 45 minutes or 1 hour. And you're going to see a lot of single prints at LP there. If it comes to Nifty, you're going to see a lot. Last 1 hour or last 45 minutes are mostly related to letter L and M. If you're seeing last letter L or M are spiking up, then those extreme are the signs that inventory is getting long to too long, or inventory is getting short to too short. So these single prints we don't consider as a long-term money. Yeah, it depends upon the location where it is happening. If it is happening at a major swing high or major swing lows, these kinds of spikes are happening. Then those are serious warning that maybe the inventory is getting long to too long, or inventory is getting short to too short. Or if you are seeing at a reversal point, then maybe it could be a sign of a long-term money. It depends. If it depends where the spike is forming, accordingly we'll rate it whether it is done by long-term players or it is done by the dumb players. Most of the time, if you're going to see at the price extreme, if you're going to see it as a swing extreme, in the direction of the swing extreme, you're going to see the spikes. They are mostly laggards, mostly late buyers or late sellers are entering into the system. Probably we might be very close to the market tops or market bottoms, right? So again, these kinds of spikes gives you a tremendous art in playing positionally. And so if you're, there are certain price patterns we looked into it when dealing with spikes. There are a couple of spike rules we follow, and based upon that, one can able to take advantage that whether there is an immediate reversal is going to come, which level to watch. The spike base is the level mostly you'll be watching out for any sudden reversals if there is a downward spike. Right, so the point of we'll be expecting the price to move away from the spike base, go back above, and try to build some upward activity above the spike base. Some point of price might be moving above this levels. It's probably you'll be seeing in the very next day you're seeing price jumps above this level, above the spike base, and you're seeing more activity happens above the spike base. Point of control is building above the spike base. That is a good sentiment. We call that as in high confidence markets. So there are certain locations we read the confidence. One of the levels where we'll be reading the confidence is the spike base, the single print levels, the P-shape profiles, double distribution levels. So many single print levels will be monitoring the market confidence, and we classify that whether it's a good buying or a weaker hand buying based upon the combination of how the price activity is developing, how the point of control is developing. Based upon that, we'll rate what kind of confidence comes. So based on that, we'll be able to take a mean reversion bets or an trend following bets. Right. So this will be intensively practicing in Tradezilla 2.0. Yeah, if there are, according to the risk profile types, we'll be classifying which profile gives a higher reward. Always the trend following, trend day and double distribution has the maximum reward. B-shape and B-shape profile have the higher rewards. Normal variation day and neutral day also has higher reward. And trend days and normal days have a medium reward, but those are the days you're going to see on day-to-day basis. So day-to-day basis, most of the time, as a market profile chart reader, you're going to see mostly you'll be doing mean reversion trades, and there are days like in trend days or If you want to see a P-shaped profile or a B-shaped profile, you're going to align in the direction of the markets, or a trend day or a double distribution day. And here's the classification. So these are very theoretical stuff. I would say that take it as a theoretical stuff. They are not followed widely in the general market practice. A non-trend day will be having narrow IB. Normal day will be having wider IB. Normal variation day has less than normal days IB, and trend day has normal IB. And double distribution days have narrow IB. Right. So that's how one can understand about the profile distribution types. Right. And I guess if you are interested to join the upcoming TradeZilla 2.0 program, what I can guarantee you is an institutional quality analysis, institutional grade way of looking into the markets, and a lot of things to learn during live markets, and more concepts will be aligned to take advantage of the traders to the information what most of the traders fail to see in the markets. And again, we're going to talk about traders' behavior. Based upon the behavior, what are the behavioral setups we're going to look into that. And that's what we're going to look into in TradeZilla 2.0 session. And yeah, I think we can, it's good time to take questions for next 10 minutes. I think a lot of questions came. It's tough to answer all those questions, but I want to take a couple of interesting questions, and I'm going to answer those questions. How much screen time on reading and understanding is generally required to be a professional trader in market profile and order flow? Very good question, Ashutosh. I would say that first of all, one have to get to know what are the information, right? What are the information one have to read from the market profile. That is a practice. So the one complete 1 month will give you enough abundant practice to practice in market profile and order flow. After that, another 2 months to get familiar with those concepts. So total 3 months, you'll be in one form to familiar with those concepts. You'll be able to understand what is happening inside the markets, very much familiar about it. So to move to an expertise level, it will take at least 6 months to 1 year to move to an expertise level. Right, and I would say that anywhere one have to give a time to learn, and then one have to give a time to practice. I would say that anywhere between 6 to 1 year is what you can approximately gain on fair expertise on market profile and order flow. Right, so as a beginner level, you can learn it in 1 month, and then the next level is the professional level. The professional level could take anywhere between 1 month to 3 months, depends upon your learning capacity. And then to move to an expertise level, you have to learn to see different market conditions, able to learn through different market dynamics. It would take 1 year to see bull markets, how the market behave in a bull market, and again another 2 years or 3 years to gain an idea about how the markets moves in sideways markets, good trending markets, slow moving markets. It takes every time you're going to learn something new, and you're going to record something new, and a bit of learning curve is involved over there, definitely. But the information odds it presents is truly, I would say that it's truly it's a long-term asset. I would say that the knowledge which you're going to gain is a long-term asset, and that's going to help you forever. Right. So yes, bit of learning curve, like an engineering subject, like a doctor. Here also a bit of learning curve is involved over here. Definitely one have to go through the learning curve process. Probably what I can do is that I had a pretty good learning curve in the last 5-6 years. I can shorten your learning curve so that you're not going through the phase what I had went. And I had to how to learn this market profile, how to aggregate those information, how to convert into a framework, how to convert into a trade. It took 5 or 6 years to come to one form. Maybe for you it could be 1.5 years rather than taking 5 years of effort. Right, so that 5 years effort could have been brought down to one year or 1.5 years. So that is what we can get through that. So the course fees, there are two ways, different ways you can. Okay, well, somebody was asking about commodities. Right now in this machine, I don't have access to commodity charts. I'm sorry for that. And so let me go to the pricing. So the pricing details are here. You can with indicator and without indicator, there are two different pricing is there in. So here you can always go and check the pricing from marketcalls.in and get into TradeZilla 2.0. Okay, it's pretty lengthy. I probably have to spend some time to learn to read the entire schedule. Here is the pricing. So with tool and without tool. The tool what you'll be getting in this package is with Bell Market Profile, the basic edition. Probably what I shown in the previous examples are Ultimate Edition. If you want to know the difference between basic editions and Ultimate Edition, always you can go to belltpo.in and you can sorry, belltpo.com, I believe. I'm sorry for that. belltpo.com. So here you can go and check the pricing of all the products which are hosted by Bell TPO for NinjaTrader 8 platform. Right, NinjaTrader 8 is the recommended platform, but if you are arranging your own tools, it's fine. And yeah, they have different set of plans also. You can check with them if you want to know more about the pricing which is provided by them. They have a bundled packages as well along with the TradeZilla package. Right? Yeah. Any other questions? We can spend another 5 more minutes on questions. How to apply the code while enrolling for TradeZilla? Probably, I think if you have been gone through Trade Action community, right? So the Trade Action portal, probably I think you might get a link. Mr. Kalai Chelvan, he's the coordinator for this event. He'll be handling he'll be mailing you all the links. If you are interested, you can apply the coupon code from the link and you can make a payments there. Is the Bell TPO software must for TradeZilla? I would say that you can access any market profile software, but if you don't have any of the access, then I would say that I would recommend Bell TPO is one of the recommended trading tool, which comes with most of our analysis and studies. Whatever analysis and studies which I am doing is on Bell TPO software. If you don't have one, you can consider taking it one. If you are otherwise, if you are good to go with any other market profile studies when it comes to TradeZilla. How can we filter potential price traps using market profile? So mostly it is behavioral patterns. It's there are many behavioral patterns which we are going to discuss, and a couple of setups involves where the traders they get themselves into the trap, which some time back I also mostly we'll be talking out day in day out about such kind of traps. We have access to a portal called Slack group, R1 private trading community. Currently 625 people are there. We'll be talking about market profile day in, day out over here. And we'll be talking about why the market should mean revert or what kind of activity is happening, whether it is strong activity or weaker activity. We'll be talking about day in, day out. We'll be talking about market confidence. We'll be talking about the key reference level, what we are watching, why the market should mean revert back, why the market should slide, or why there should be a big drop coming into the markets. So it's a repeated practice. We are doing this for more than now 2 years now. The community is now 2 years old, and more and more people. It helps the traders not only to revise but also to practice. We also do conduct a lot of webinar session. Post TradeZilla, we'll be doing a lot of follow-up webinars. And those webinars are at free of cost only for the membership. It's kind of a membership portal, and who are having access to it, they'll be attending those sessions. Like something like recently we done a webinar on how to understand the intraday and short-term trading inventory using market profile, where you know that intraday players are getting long to too long, so that from an intraday perspective you can take advantage of those moves, or where the short-term traders are getting long to too long, so that we can positionally take advantage of those moves. And how to read the inventory, that is itself a skill, right? So and that again, it's a set of practice, it's a set of frameworks which we follow. Yeah, questions? So which is the recommended vendor? Yeah, you can stick with global data feeds or true data. Almost everyone gives the same data. right? So it doesn't matter whether you are sticking with global data feeds or true data or e-signal. The quality remains the same. Only the pricing differs, but the quality of the vendors remains same across the markets. Do you share the today's slides presentation? Yes, of course, I'm going to share today's slides presentation. I'm going to send you the recorded video as well, and probably Mr. Kalai Chelvan will be. I'll be sending it to Mr. Kalai Chelvan. He'll be receiving those information from Kalai's mail. How market profile help in identifying more buyer or seller in the markets? I don't think more buyer or more seller gives an odds. Basically, I think your question, Mr. Rajendra Birkede, is your question is to understand where smart money is entering or where the smart money is entering the markets. I guess, right? Yeah, probably there are many places smart money take advantage of that. Before that, there will be a set of behavior which will happen before the smart money is going to initiate. And some of the places like single prints are the one places where smart money might be involved. Where those are the places where those are the interested parties. You can find it over there, kind of a double distribution pattern or some sort of an normal variation day, where it comes with single prints, right? So those are the places we'll be able to see that smart money could be involved over there with a greater accuracy. Not every time it's going to be the same thing. Yeah, there are times even with double distribution market could fail. But where, at what location it is happening, how it is happening, how the volumes are getting transacted, everything it really matters there. It's a cumulative data points on how to look into. Okay, I'll be sending you the recorded sessions as well. Yeah. Is option trading covered in TradeZilla? See, first of all, in TradeZilla, what we'll be covering is we are not going to talk about option concepts like the option Greeks or something like that. We'll be covering how to trade options relative to the view, how to take a view. It's a view-based approach. That's what we're going to follow mostly using market profile. Using market profile, how to take a view. Probably how to take options and what are the times you have to take you have to take a trade using options, when you should avoid trading naked options, when to write options, when to avoid naked option writing. Probably that kind of, from that aspects we can cover it, but we will not be covering on strategies like straddles or strangles. And of course there are different courses out there in the markets you can go and attend there, but what kind of mixture of options you can practice, right? So how to take a view, that is more important. Once you have a view, then you can play with any kind of options to take a neutral approach in the markets, or once the view is pretty much clear, you can go and play with butterflies or iron condors. It doesn't matter, right? So first of all, how to get a view, how to understand the behavior, that is the core subject we're going to deal with. Yes, options are the peripheral things. We are going to relate with options, how to trade options, doing events, how one have to handle the events. While one have to bet before the events or after the events, how long to wait because IVA used to crash. So those are some market internals, how to make use of those market internals to take a delayed bet in the markets. That's what we'll be mostly discussing over there. Yeah, options. I'm more of an option trader than a future trader. I'll be discussing more from the option perspective as well. Sure, I'll try to share if there is any commodity simulation with the MP. I'll share, but most likely it doesn't matter whatever the asset classes are. The trading activity remains more or less the same. What is the Slack channel validity? Another interesting question. The Slack channel validity is for lifetime, and that is only for a close member group who are having access to TradeZilla or Order Flow webinars or the AMI Broker webinars who were attended in the past and in the future. Right, I guess it's been quite some time. It's time to wind up, and thank you for patiently attending and hearing to my webinar, and thank you for showing so much of interest in market profile. Hope to see you in the TradeZilla session. Thank you. Thank you, everyone. Have a wonderful evening. See you next time. Bye bye.